Okay, well, I'm sorry, sorry about that. I was in the middle of talking about this particular issue of the of capital contributions by non-shareholders, and for whatever reason, everything just went out on me. I don't know what that was about, and I have to tell you that sometime between the spring and summer terms, they did some software updates, and I'm still trying to get used to it a little bit. Typically I do a lot of recording actually, most particularly for like a routine basis for my Attend Anywhere courses, but some things have changed a little bit. I will admit that I'm not 100% versed on what's going on, so hopefully we won't. I apologize for having two different video streams, but that's kind of the way we had to do it here. I did not want to lose because it looked like all the power was going out. I did not want to lose what I'd already recorded. So anyway, let's pick it up from where we left off. We were talking about capital contributions, and we talked a bit about localities donating properties, things like improvements to land and infrastructure and whatnot. And we were just getting into contributions by non-shareholders. And one example would be a customer who might contribute something to aid in something that the firm under question is doing. I don't know how common this is, frankly. I don't know why a company would do it, but like a lot of these scenarios, even like something like transferring liabilities, I don't know how that common it is, but unless it's defined, somebody will do it, and if there's no definition of what to do about it, then nobody knows how to handle it. So this might not be that common, but if that is the case, it would just be simply the fact that the corporation would recognize income. And the same goes here if there's an exchange of goods or services. In other words, kind of a barter transaction. And if you might remember from 2320 that barter transactions are indeed taxable, whether there's no cash involved at all. So in this case, an economic exchange of goods or services for whatever other kind of consideration, it becomes a taxable event. Okay. Any kind of basis of the property the shareholder transfers is the shareholder's basis on the contribution date. But if there's a building losses, we've already talked about, then the basis is reduced. The basis in those assets is reduced, and that's simply because of the fact that the fair market value exceeds the basis exceeds the fair market value, and so as a result, you've got to make that adjustment. And we talked about that a second ago. Okay, quick knowledge check activity with reference to the contributions made by a civic or government entity. I would say primarily government entity to induce the corporation to locate in a particular community. What should a corporation do? Well, treat it as tax-free, no, doesn't sound right. Treat it as a fair market value basis in the assets. Contributions are added on an adjusted basis. Contributions are totally ignored. That doesn't sound right. Contributions are excluded from the corporation's gross income. Sounds like that's going to be B, and it is. Contributions are reported at a fair market value in the assets. And why would they not be? It actually wouldn't make a lot of sense otherwise for that to be the case. Okay. All right. Sort of wrapping up our discussion of capital structure, we're going to talk a bit about capital structure and some of the issues. We talked a bit about the differential treatment of debt and equity tax-wise, and we'll talk about some of the reasons and some of the backstory, I guess you would say, behind that. And the one thing is, should be maybe already obvious to a lot of people, and that is the advantages of debt. And the one big advantage, it's a huge advantage, is the fact that any interest that's paid to debt holders is deductible by the corporation. Without limitation, although there are some limitations that were built into the Tax Cut and Jobs Act, I would say most companies would not face that, but interest is fully tax deductible, as opposed to dividends, which are not deductible to the company. So in this regard, it makes sense for a company to prefer debt over equity. And this goes to, for those of you who've taken a corporate finance course, you might recall something called the Modigliani-Miller model that said that a company is indifferent to the capital structure of debt or equity, which implies that debt is not as disadvantageous as equity. There are some issues with debt in terms of the fact that creditors expect to be paid on time and with interest, but we are talking primarily about the tax issues here. Any interest paid is taxable as ordinary income to the individual or the corporate recipient, and in that regard, that's I don't know that I would put that as under advantages of debt necessarily, because dividends are actually the recipient has a lower dividend tax rate than interest tax rate, but nonetheless, the benefit to the corporation doing the paying in this case is getting a tax deduction where they do not get any deduction at all with the dividend. And one reason why is because dividends are from an accounting standpoint, a technical accounting standpoint, distribution of equity back to owners, and they do pay tax on it. But I know that a lot of people think dividends are distribution of earnings, and there is a correlation, but the actual transaction is a distribution out of retained earnings. Okay, loan repayments are not taxable investors. This basically it's kind of a strange place to put it under advantages of debt. I think we're talking about principal here, and why would they be taxable? I mean, there's already a basis in the amount loaned, and so they would pay tax on the amount that's being paid in interest, but not in the principal itself. Under equity, corporation pays dividends, which again are not deductible, and to individuals, it is taxed at lower rates, dividends, and so that's one of the good things about dividend taxes is that they are preferable in some cases to interest. In fact, this is one of the attractions. Preferred stock to investors is the idea that the dividends are paid, which, you know, again, preferred shares are a little bit more like debt, in my opinion, than they are equity, and they're taxed at the dividend rate, which is lower than the ordinary rate typically, and so as a result, there is that advantage, and it also has the advantage of being, you know, more or less guaranteed. I know that we talk about cumulative versus non-cumulative shares, but without muddying the waters, there is a tax advantage in that regard. Okay, I want to talk about this idea of thin capitalization. This is a really important issue because a company really risks having the IRS recharacterize some of the debt of a company. In other words, that debt part of the capitalization as equity, and so therefore, any kind of payments to shareholders are considered dividends and hence not tax or not deductible, whereas interest payments are deductible. And so again, a company sometimes has a preference of debt over equity in that regard. But the issue is the IRS may think, you know what you're really doing here is you're disguising equity as debt just in order to lower the corporate tax rate. And then who knows, whatever the tax rate is applicable to individual owners, they may not pay any tax at all. Who knows, you know? You know, the idea is to not disguise debt as equity in this case. And we'll get into some issues here in a second about how the IRS makes these determinations, including if it has a lot of features of stock, like a variable amount of payment being made to owners in terms of interest. That looks a little bit more like equity, or if it's dependent upon earnings, that looks a lot like equity. And so as a result, the company may, or the IRS, may make a determination that something is really going on there. So, and by the way, we've heard quite a lot in the last few years about companies that are extracting a lot of value out of other companies by simply forcing debt upon them, taking big ownerships in the company, and then recharacterizing the obligations as debt. And there's one really well-known case, and I won't specify the details, and we've heard a lot about hedge funds. Hedge funds have the advantage of, you know, being investment vehicles for high net worth individuals and institutions, and they're pretty much allowed to do whatever. There aren't the consumer protections, but in exchange for those lack of consumer protections, because these are wealthier individuals, the investment owners can pretty much do what they like. Well, there was a case in which a hedge fund had invested in a company. The company was already struggling, but lots of assets, and probably purchased those assets below fair market value. Fair market value sometimes is a very subjective determination anyway. But what happened was all this debt was owed to the hedge fund, and the company was paying huge amounts of interest, which was good for the investors of the hedge fund, but it was really depleting the capital of the company itself. There's a very high debt to equity ratio, and a company that has too much debt in relation to equity is already unbalanced, and ultimately resulted in the demise of the company itself. And it's just really a way to boost the earnings of the investment vehicle, the hedge fund, which owned the stock of the company, and basically forced a lot of debt. Basically, the company went into a tremendous amount of debt to the investors in the hedge fund itself. And so, so from a public policy standpoint, I think that it's perfectly legal, but from a public policy standpoint, we want that sort of thing to happen. And so I think this is a contributing factor, I think, to this idea of thin capitalization. So I talked about what are some of the considerations that the IRS will look at in order to make this determination of a thin capitalization. One big one is the debt to equity ratio. This is simply the debt to equity ratio, the total liabilities divided by total stockholders' equity. Stockholders' equity being composed of, paid-in capital as well as earned capital or retained earnings. And so, if this is too high, then it may be the case in which the IRS will say, well, you're disguising debt, or disguising equity here as debt, and so we're going to reclassify that. I don't know that there is a threshold. I know that a little bit later on we'll see whether if it's greater than 1-to-1. I think that's probably not the case. I think it's a much higher debt to equity ratio than that. Maybe not. Well, I shouldn't say much higher, but I think it's higher than that. I think there are a lot of companies that have a 1-to-1 debt to equity ratio. In fact, some have a much higher ratio of debt to equity, and but there could be some ways around that, and there's some issues in terms of justification. But one way is if the debt instrument documentation is a little bit vague, if it's not, or if there is no documentation, that's a problem. If equity is being disguised as debt, there's really no documentation as to what the terms of this debt are and whatnot. Nothing is really spelled out. Is there a definite rate of interest, a definite maturity date? If that's all lacking, then that doesn't look very much like debt to the IRS. What are the terms that they're not very well spelled out? Contingency of payment on earnings. This doesn't. How do you get more equity-like than that? Debt is simply something that's typically independent of earnings. It's just simply an IOU from one party to the other, and usually creditors don't take an interest in the amount of earnings, other than the fact that they want earnings to be there so that they get paid on time and with interest. But that sort of contingency is a little bit too close to equity in the first place. Any kind of subordination of debt. When we see subordination of debt, oftentimes it's done by lenders, where if there's a lot of subordination of debt, what happens is, and a lot of times these are loans from very closely held businesses where the shareholders are majority shareholders, and they lend money to the company itself, and lenders will say, you know what, you have to subordinate that debt, and when push comes to shove, you pay our debt before you pay debt back to yourself. Well, that becomes part of the capital base, and so if there's a lot of subordination of debt, then that becomes sort of a question mark. And is that debt or is that equity? So, and we're not going to get a lot into debt subordination, but that could be one consideration. And then also the issue of whether debt and stock holdings are proportionate. That is this goes to capital structure. Also, what the use of the funds are. Are they for business purpose or are they for something else? And again, non-business purposes, businesses doing things for non-business reasons are a bit of a question mark, and it creates a question that companies don't want to have to answer, in other words. And so, a business should be set up for business purposes. Maybe that goes without saying, but there are cases in which that doesn't always exist. And we're going to come back to some of this a bit later. Particularly after the Tax Cut and Jobs Act, when the corporate tax rate was lower, the IRS wants to make sure, because the corporate tax rate now is lower on C corps is lower than many marginal income tax individual tax brackets, and so as a result, the IRS doesn't want people to form corporations just for the basis of taking a lower tax rate, getting a benefit from nothing really. Quick knowledge check: which of the following statements regarding debt and equity is not true? A, interest paid to the debt holder is deductible. That's true. Loan repayments are not taxable to investors. That sounds true to me. C, dividends paid are deductible. That does not sound true. Interest paid is taxable as ordinary income to the individual, so it's going to be C. Dividends are paid or deductible, which is, when I say it's true, it means that statement is false. That's what they're being asked about there. Dividends are not deductible. Those are capital distributions. Okay. We have 3 sections. One is very short, but I do want to talk a bit about losses and what's going on here. And when we talk about losses, and that if stocks and bonds are considered to be capital assets, then if these become worthless, they become capital losses. Why is this a big deal? Because they're not ordinary. In other words, ordinary losses by and large are preferred as opposed to capital losses. Ordinary losses can be typically deducted in full. Capital losses have to be offset against capital gains in a corporate tax context. And so in this regard, if these are considered capital losses, depending on who the owner is, it's a corporation or individual, but capital losses are what the treatment is going to be. And there's no loss for any mere decline in value. In other words, there's no unrealized loss recognition that's going on. I know there was talk during the last presidential election about potential unrealized capital gains tax, which made a lot of a buzz in the accounting world, the tax world, because nobody could figure out how that would work. Well, nobody could figure out how to do loss recognition for just a decline in value, and how you reclassify it, and what dates, and what if these are closely held companies? How do you value a decline in value? Becomes quite difficult. So you kind of get the idea. If stocks and bonds are not capital assets, then these become ordinary losses. And this is primarily talking about financial companies, typically investment firms that have securities that are part of inventory and not capital assets. And a lot of brokers hold securities, stocks, and bonds and whatever, and it becomes part of their inventory. And if they lose, that becomes a business loss, an ordinary loss. And it could create a net operating loss, depending upon what all else is going on. But that's what's really going on. And sometimes the ordinary loss is disallowed if the stock is of an affiliated company. And that's a little bit, there are a lot of different things to be said about that, but we'll not talk about that here. The issue of business versus non-business bad debts. Okay, so any kind of losses from corporate debt is either treated as business or non-business bad debt. Now, if it's a loan from an individual and it's an investment, it's considered a non-business bad debt. Okay, and in this case, we're talking about a short-term capital loss, and it's only deductible when it's all the way worthless. And typically, what happens there is it becomes something like an adjusting entry when that's being recognized. And so as a result, it's the individual shareholders who lend money to a corporation. They do so on the basis of the loans potentially becoming non-business bad debt. They should realize that is considered to be that. Okay. When it comes to business versus non-business bad debt, if the corporation is an actual lender, and we're thinking about banks and other institutional type lenders, the loss is considered business bad debt, and that's an ordinary loss, so not subject to the restrictions on or the limitations that exist with capital losses. And there is a deduction allowed for partial worthlessness. This is when a debt becomes less collectible. This is typically the case with banks, where banks will sometimes mark down the value of an asset, which is a loan, their loan to a borrower. They may mark it down thinking that it's not all going to be repaid. Sometimes companies that are borrowing money from banks go into bankruptcy, and sometimes it doesn't mean bankruptcy doesn't always mean liquidation and complete going out of business. It simply means time to restructure and reorganize things. And sometimes debts are marked down. Companies take what's called a haircut, and so as a result, it becomes partially worthless. It's a deduction, and it should be a deduction because of the fact that they will never recover the principal which they're marking off. And any bad debts of a corporate lender can qualify as a business bad debt. Okay. So, and it's not just banks, I suppose. It could be any sort of institutional type lender, but individuals, it's hard to say those are business debts because really, again, that even may look more like equity than debt. So, that sort of treatment IRS is a little bit more skeptical of that. A non-corporate lender may qualify for business bad debt treatment if the loan is made in some capacity. Again, that's a business purpose, qualifies as a trade or business. So this case, it does not have to be necessarily a bank. It could be some other lender. But if you're going to establish that it is for a business purpose, and if the shareholders who is in the business of lending money, and that would make some sense as well. So again, this kind of goes to the idea that the facts and circumstances apply, and it's this idea that it does drive people crazy when the answer to a question is it depends. And so when it comes to treatment of these losses to investors who are lending money to companies that eventually either can't pay or have to lender us to take a bit of a loss, how do we treat them? And the answer is it depends, and it depends on some of those factors that we just talked about there. Okay. 1244 stock is basically, 1244 is simply part of the code that deals with loss treatment on small business corporations. Any gain is still considered to be a capital gain if there's a disposition, if and when there's a disposition. But under 1244, losses apply to the first $1 million of the corporation's stock. And if the corporation issues more than $1 million in stock, then there has to be a designation of which shares qualify for 1244 treatment. That's something the company will have to do, and there's a plan for that. And the measuring of the value of the date is adjusted basis minus any liabilities assumed by the corporation, which we've seen before. Fair market value of the property is not considered. So the corporation's assumption of any liabilities, again, reduces the value of equity. And this results in a reduction in basis. And so that's essentially what's going on there. The limitation here is limited to 50,000 for individual filers, 100,000 for married filing joint. And I can't tell you what it would be for married filing separate. That's always a tricky matter there. So if anybody's really concerned about that, we can look into it. But clearly, individual and married filing joint are the most common. And I would presume as well that head of household would be also part of that, part of the more analogous to the joint return. There may be a different figure altogether, but I can't imagine it's disallowed at all. Any remaining loss becomes capital loss, and so the original holders of the 1244 qualify. So, so we're talking about original owners of the company. This is not shares that have been passed along, and in order to qualify for this 1244 treatment. Okay, and again, when we get to this issue of basis exceeding the current fair market value, the basis has to be reduced to the fair market value on the date of exchange, and we've seen that before in terms of cases in which fair market value is less than basis. Okay, and I'm going to skip the knowledge check here just to kind of move on. We have a really quick segment, really quick segment dealing with gains from qualified small business stock, and then we have one final piece here, and then we'll be done with this. And again, I'm always available to answer questions, and you know, if you do have questions about any of the material in the text at all. And this unit deals with qualified small business stock. This is really interesting and really a great tax benefit in so many ways. And what this section really does is encourages investment in startups in particular, particularly those with high growth potential. And it also affords early investors with some tax relief on gains from their disposition of these stock ownership positions. There are some requirements, though, in order to get this. We'll talk about what these benefits are. In other words, 100% of the gain. We'll talk about the limitations here in a minute, but non-corporate shareholders may exclude a portion of the gain from this disposition if they've held it for at least 5 years and acquired as part of the original issue. Okay, an exclusion is to the grade of $10 million or 10 times the adjusted basis of the stock that was disposed of during the year. You don't have to dispose of all your stock, but the portion that was, and so it's essentially 10 times that adjusted basis. And adjusted basis is likely the original cost, so 10 times original cost probably. Exclusion percentage is 50, 75, or 100, but it was after 2010. There was a phase in this particular case. Qualified small business corp is typically a C corp with gross assets not greater than 50 million. And again, we come to this idea of small businesses, and I know that a lot of people have this idea that small businesses are maybe family owned, maybe husband or wife, something like that. And the term I absolutely hate is mom and pop operations, because it does not really describe all that many companies that do $50 million in revenue. I'm not saying it can't happen, but I think it's a really old-fashioned, outdated way of looking at it. And the upper limit on small business, on the definition of small business, has risen over the years and probably will continue to do so, just for no other reason than inflation. But you know, even as I've said some 30 years ago, the SBA, Small Business Administration, considered 25 million to be small, and I think they have raised that as well. Again, different parts of the government have different definitions of small business, and even small business definitions change within the tax code itself. So again, this is what makes tax a little bit tricky. You just got to know what it is you're looking at. And again, it has to be actively involved in an actual business. And again, the 80% of the assets are used in the active conduct of some business, again, as a function of control. In other words, not more than 20% can be purely, passive owners in that case. All right, final discussion here is going to be dealing with tax planning. We do talk intermittently about tax planning, and the thing that, again, I try to emphasize is the complex nature of tax planning, and really what I would call the holistic nature of clients' situations, and really trying to find out what's going on. But one of the great things about being an accountant, I think, particularly a tax accountant, is that your clients really appreciate what it is that we do, and they're grateful, particularly if you can point out some areas that they were not aware of. And most people are not aware of a lot of these things. There are a lot of, I mean, just the provisions we talked about now. I think this would fly under the radar of a lot of owners, even some very sophisticated owners. And by the way, I know we've said this before, but a lot of CPAs themselves don't have any involvement in tax, and probably they themselves are not always familiar with it. So, and that was just fine, because I don't know much about auditing. I mean, I've had my share of auditing courses and had my share of dealing with auditors, but in the accounting world, we typically go one of two ways. And but I do like the tax side of things, because I think that we can really do things that are really meaningful and allow companies to take advantage of provisions that they may not be aware. And by the way, the Tax Cut and Jobs Act is set to expire at the end of 2025. And I wouldn't want to make a prediction as to what's going to happen. I suspect most of the provisions will remain. I don't know what happens to marginal rates on corporations. There's discussion about those going down further, but we will see. And there may be things we haven't seen yet, but this is why we keep up on what's going on. And it requires, if you're going to be in the tax business, there's a reason why we have continuing ed requirements. It's so that we can keep up on what is happening, whether it's from corporate or individual tax clients. A lot of tax accountants will handle both. Okay, so under 351 again, sort of wrapping, shareholders should ensure the parties receive control. Again, we go back to this control group issue, making sure that this is locked down, because if this is not resolved and there's ambiguity there, then the deferral treatment may not apply. And that's something that shareholders who are contributing property may really rely upon, and having it disallowed is going to be a bad day. The gain deferral requires a large contribution of assets of new shareholders in the case of mature corporations. Now, this goes back to kind of what I said earlier, that yes, 351 is associated with newer companies, new startups. However, it will also apply to existing companies, but it's more complicated. And one issue is the fact that the IRS wants to make sure that a new control group is not set up just to allow people to escape taxation on those assets which are contributed. And it has to make sense. Transactions got to be there, and typically existing shareholders need to contribute additional property in their own right, particularly if new stock is issued. So, and then the value of the new stock is relatively small compared to already owned stocks. It's so 351 treatment is primarily, not exclusively, but we think of it, I think, most of this in terms of startups, but it can exist. I do want to talk about some cases. I think I alluded to this a second ago when we talked a bit about, or actually in the first video, talking about when you might not want to receive 351 treatment. And that is if the transferors who are transferring the property have already got a low tax rate for whatever reason, and they might want to go ahead and take the gain now, rather than take the gain sometime down the road, which immediately establishes their basis. They don't lose basis by doing it. They do have to pay tax on it at that point, but maybe it's in a condition in which they're going to have a low tax rate that particular year, or something is going on, and maybe they want to offset some gains. Some losses available in other areas. They're taking losses, and so if they've got losses, maybe they want to use those losses to offset gains. Capital losses offset capital gains. So you kind of get the idea. There may be some reasons why somebody would want to do that. It's interesting too that a lot of times during recessions, a lot of taxpayers will try to take advantage of the situation to sort of clean things up on their books, and maybe take a gain now rather than take a gain later. Get this off the books. Maybe you got some losses you want to take, get those cleaned up. And there might be reasons. And I know it sounds a little bit crazy, but sometimes recessions create opportunities in order to do certain things, particularly when it comes to taking losses, but also it could be gains as well. Also, because of the fact that Remember, 351 allows deferral of gain, tax recognition of gain. It also means deferral of recognition of loss. So they may want to take the loss immediately as opposed to take the loss down the road as well. Remember, if you're going to offer somebody a deferral of gain, you also have to have deferral of loss as well. At least that's the logic of this. It could be the transferor wants to take this loss for all kinds of reasons. They have alternatives in order to avoid just actually taking the loss. One is to simply sell the property to the corporation for stock. This is, I think, particularly useful when you've got property that doesn't really match up very well with what the business that you're investing in happens to be. And there was an example that when I was in banking, I was a commercial lender. We had a company that was a dairy, and they wanted to buy a string of gas stations. It was, they made cartons of milk. They wanted to buy gas stations, and the owners of the gas station didn't really know what they were going to do with dairy assets. And this is the first and only time I've ever been in a dairy, and it did not look like equipment that anybody would use in any other kind of function. So sometimes the assets themselves just don't really make a lot of sense. Sometimes it doesn't. It's hard to determine a fair market value of some assets. There are some assets that are just totally unique, and it's really hard to know what the value of those are in the first place. Land, I guess, is a little bit easier to establish from that standpoint. You could defer gains, but what about some kinds of equipment and whatnot? It's a little bit difficult. So you may just want to sell the property, take whatever kind of loss you've got going on, then take the cash and invest it. That might make sense. Or you might want to engage in a lease transaction, which I think I'm going to talk about in a second. Or you can sell the property outright, not invest, and just simply sell it. That's one way to do that if they wanted to take a loss, if that's coming their way. Again, all this is ignoring and avoiding, for one's own particular purposes, 351 treatment, or they might transfer the property to the corporation in return for debt or non-qualified preferred stock. And again, that non-qualified preferred stock again has much more attributes of debt than it does equity. Okay, and then there's a question here about. I'm not going to talk a little bit. I'm going to come back to this issue a bit later in the course. The transferring of assets to produce passive income may involve the invocation of personal holding company penalty taxes. And we're going to come back a bit to this later because there's a lot more that I want to say about this. But just for right now, know that passive income obviously is treated differently than active income, and same with passive losses against passive active losses. But again, the IRS has got a strong interest in preventing people from obtaining a tax benefit that is not of a legitimate sort of purpose. And leasing properties makes a lot of sense. And I am a big fan of leasing. I think there's a lot of advantages to doing it. And there are very different kinds of leases, or what we call balance sheet leases, the operating leases, which are a little bit different. And but it's a way to take money out of the corporation in a deductible form, because you might want to lease. In other words, leasing an asset to the company itself. The company then pays you a stream of income as you as an investor, and those lease payments are generally 100% deductible to the company. There's a benefit to the company in this regard, and then whoever's leasing the property gets an income stream from them, and may even get the assets back at the end of the lease, depending upon the type of lease. So there are a lot of advantages to leasing, and we get into this for those of you who took intermediate accounting here. I think we got to do a little bit in intermediate 1. I don't teach intermediate 2 here, so I don't know if we get into that a lot, but leasing is an interesting option that should be considered. And also any kind of consideration of what kind of liabilities are going to be transferred. Again, not all liabilities are easily transferable. And again, I'm a little bit skeptical as to the ability at times to transfer liabilities from one party to another, simply because there's an other end of the liability transaction that may or may not want to assume that their particular asset, which is a loan owing to them, with some new borrower that they don't know about. So but again, I'm not saying it never happens. It certainly used to happen a lot in the mortgage business, where people would assume someone's mortgage and whatnot. So it's not unheard of. But again, if there was no rule against something, then once it does happen, it'd be hard to know what to do about it. And this is why we have all these different scenarios. When we talk about debt, we go back to this idea of thin capitalization. And one way to not have debt reclassified as equity is to basically make sure that the debt itself is quite formal, that it's written and the terms are spelled out, interest rate, repayment, repayment terms, maturity date, how the rate is set. Is it variable? Is it fixed? Is there collateral? Whatever the case might be. Obviously, collateral is a pretty good indication that we're talking about debt as opposed to equity. And any kind of conversion, maybe to avoid any kind of conversion that makes the debt convertible to equity. Remember, you don't want debt to be characterized as equity. And so one of the characteristics of some preferred shares is that they have convertibility options to equity. In other words, convertible from preferred shares to common shares. Well, if the debt instrument allows something like that, even though it may not be preferred stock, it's just a regular loan, that is kind of a tip off, and I think you want to avoid that. It looks too much like equity in that case. And also shareholders owning debt in proportion to their shareholding. And we invite any kind of IRS reclassification. And what they're really saying is that if the debt that shareholders own is in rough proportion to their equity, then is that really debt or is that really equity? How is this debt being repaid? Is it like a lot of equity payments are quite variable. Companies don't even have to pay dividends at all. And if you have a debt obligation that doesn't really tie the borrowing entity, which is the firm in this case, to any kind of repayment, that looks an awful lot like equity. And to the extent that people invest a lot of, are extracting debt out of businesses, again, it's contrary to public policy in this regard, and the debt can actually be reclassified as equity, and that's not what is being looked for by any party here in this, except the IRS. And trying to keep the debt to equity ratio within reasonable proportions. There is one interesting argument. I think it's the next slide here about. It's a strategy to respond to this claim that the IRS might make. So, the IRS has the right to challenge tax treatment and does. And I know the tax accountants, I know when I was coming up as an undergraduate, first tax course I took, we were sort of encouraged to, how do I want to say, not push the envelope, but to, take an aggressive tax position if we felt like we could justify it. Now, we are bound by, IRS regulations to not take a tax position that we reasonably believe cannot be sustained. We can't claim a depreciation rate that is way too high in relation to the type of asset. If we know that's wrong, we can't do it. But in this case, we are allowed to take aggressive positions if we could justify it. And that's called helping your client. It's called serving your client. But we can't do it when we know it's a flagrant violation. And there is a difference. And is there a thin line at times? Yeah, there probably is a thin line. But in this case, how do we respond to this particular challenge that the IRS might make? Is we can say, okay, well, don't look at the debt to equity ratio using the GAAP values, that's historical value, rather take fair market value. And the fair market value may result in a debt to equity ratio, which may be quite different. We may have lots of appreciated assets, and things may be a little bit different. Remember, we put assets on the books in GAAP accounting at primarily their historical cost. And so one way to avoid that is to be able to step up the value using fair market value. And that would be a pretty reasonable argument. I don't think there's anything wrong with making that argument. There's no guarantee any kind of argument's going to work. But this is why we have people licensed to practice before the IRS, so they can make these arguments on behalf of their clients, whether they're CPAs or enrolled agents or attorneys. All are empowered to represent their clients in front of the IRS and to make these particular claims. Again, there's no guarantee of success, but that might be something to consider. And I'm not going to talk a lot about this in terms of flow through entities or pass through entities, because we're going to get to this a bit later. And I'm not 100% sure what we're really trying to present here. Yes, double taxation does present a tax disadvantage for corporations, in the sense that the corporation, a C corp, will pay tax on earnings, and then any dividends distributed to shareholders would be taxed again. And a lot of people call that double taxation. Personally, I may be one of the very few people in this business who doesn't really agree that it is double taxation because these are different entities, and you can't. That's one of the benefits of having a corporation is limited liability. And if you're going to have limited liability and say, well, these are not my liabilities if something bad happens, so if you are going to create a separate legal identity, then you have a separate legal identity for tax as well. So I may be one of the few. I know that this is not a popular position. It's probably not something a lot of clients want to hear, so I may want to keep that under my hat. But the thing about pass-throughs, we're talking primarily about sub-S corporations, partnerships as well, is that the corporate tax rate, C corp tax rate, went to 21%, and now the tax disadvantage is a little bit less to corporations because of that. But these pass-through entities got a new deduction under the Tax Cut and Jobs Act, and we're going to talk about that. And it's a way to take to benefit non-C corps, to give them also some of the benefits that accrue to C corporations as a result of the Tax Cut and Jobs Act. And we're going to get to those a bit later. So for right now, I don't want to cover that in too much detail. One final knowledge check: in the context of avoiding 351 treatment, which of the following alternatives is not applicable? Transferring the property to receive control, selling the property to the corporation for its stock. Again, we're talking about avoiding 351, selling the property to the corporation for cash, transferring the property to the corporation for its non-qualified preferred stock. And the answer is transferring the corporation to receive control. That is 351 treatment. So by definition, that would not. The others would be alternatives in the case of those who wish to avoid 351 treatment. And people make these elections all the time to either take advantage of a benefit or not to take advantage of a benefit. And you are free to make certain elections, and this is one of those elections. And this is really the main thrust of this particular chapter, is this provision of the tax code. And sometimes you can avail yourself of these options and sometimes not. You're not required in some cases to take certain tax benefits that are offered to you. Some cases you are, frankly, even in corporate tax, but oftentimes there are elections that are made, and so filers will have to decide what is best for them. And again, this is where consultation and this holistic approach is really mandated. Okay. Well, I hope this was meaningful to you. I apologize for having two different video streams. Couldn't be avoided. It was unexpected. Hopefully that is not a recurring issue. This was a fairly long bit of discussion, but there's a lot going on here. It's a relatively dense topic in its own right. And the next topic will be in chapter 19. We're still on the subject of corporate tax. We're going to move on to a different element of that. So again, as always, feel free to get with me whenever you like, and I'll be more than glad to help. Thanks.